Good afternoon, everyone. My name is Was Rahman from UKTI. Welcome to our webinar, Exporting Essentials, How to Get Paid. I think most of you have signed up through Open to Export, and I hope are looking forward to a webinar where we've got three excellent speakers from HSBC, UK Export Finance and Western Union Business Solutions that will be talking us through what seems to be not just a very interesting topic, but something that most people are really very keen to find out more about. It's one of a series of three webinars on financing that we're running. What I'd like to do is, before we get into the speakers and the session, just talk a little bit about housekeeping. We're using a webinar facility that allows you to ask questions by typing into the box that you can see. Most of you should have dialed in and are either connected through your computer so you can hear with the microphone and speakers, or if you'd rather use a telephone line because it's clearer, you can click on the telephone button that's outlined in red on the screen in front of you. If you do have any questions, what we're going to try and do is make this a very interactive session. And so we would like people to type in questions as we're going, and as I see them, I'll put them to the speakers either while they're speaking or at the end. So don't worry about waiting until the end for anything you want to ask, and we'll queue them up. We've already got quite a few waiting. You've all seen Open to Export, I hope. Certainly it's what we found in the past is on these webinars and other topics, the webinar leads to a lot of discussions and a lot of questions, and the people that follow up by registering on the site and then asking more detailed questions and follow-up tend to get quite a lot more out of it. So I'd strongly encourage anyone that hasn't registered to register on Open to Export. In order to give our speakers a sense of who we've got listening, we've got quite a few people, mostly UK-based I can see. We're going to start with a very quick poll where what you'll see in a moment is a set of questions, multiple choice, where if you can tell us what your experience is with exporting, if you could all now just click on one of the buttons, it'll give us a sense of who we're speaking to and we can pitch the conversation accordingly. So if I take a look at my screen, I can see that most people are voting. We've got about half of you through now. Just another few seconds to get the last few. I think there's about 10 of you that are left to click, if you wouldn't mind, please. Excellent. And so we'll get on to the results now. And what it shows is that most people on the line are new to exporting or just started. So if we move on to the presentations, what we'll hopefully get is a series of questions around getting started. We've got Martin Rogers from HSBC. He's going to spend a few minutes talking to us about getting paid for export. Martin's a Regional International Business Manager. He's based in the Northeast, and he's got over 3 decades of very relevant experience, including some time in markets in China and the Middle East. Martin, if I could hand over to you, let's look forward to what you have to say, please.
Okay, thank you very much. Good afternoon, everybody. My name is Martin Rogers, 35 years, I say, in HSBC, Midland Bank, always involved with the international trade side of the business. So for my session, I'll be going through the various methods of getting paid for your exports. And as I'm going through, please stop and ask any questions if you feel that's relevant. So the first slide I'm going to look at is what we call the risk ladder. Now, the risk ladder, if you can see the risk ladder there, we have on the left-hand side, we have the exporter, and the right-hand side, the importer. So I'm going to concentrate really on the export side of the slide today. And if you see at the top, we have, the first thing we have there is open account. So open account transactions is the least secure payment method. So basically with an open account transaction, you ship the goods out and then hope you get paid. And probably hope you get paid. So it's the most secure for the importer because he's got the goods and he can decide when he wants to pay you. Then looking at the bottom of the ladder, we have the most secure method of payment, which is advance payment. So advance payment and open account are both very cheap methods of making payments because there are no bank transactions involved. But the advance payment, although it's the most secure for you, it's the least secure for the importer. So if you're entering into a contract with somebody who's buying goods from you and you ask them for advance payment, they're most likely going to say to you, no chance really, because they've paid out the funds and they haven't got any goods. So then we come to the other forms on there, and then coming down from the top we have documents against acceptance, documents against payment, which is the first method I'll go through, then documentary credit, and then confirmed documentary credit.
Martin,
so looking at the next, sorry,
yeah. Could I just ask a question? We've got quite a few, as I say, people that are relatively new to exporting. One of the questions that occurs to people is, I'm not sure too many starting SMEs or starting exporters know whether it's really their choice which of these they follow, or is it up to the person they're selling to? How do you, I mean, do you have the choice of picking one of these? How does it work in practice?
Yeah, in practice, I mean, the first thing you have between yourselves is the commercial contract. And on the commercial contract, you can stress to them what method of payment you would like. Whether they agree with that or not really depends on the relationship between yourselves. So if you're sending some goods to somebody we don't know at all, that somebody wants to buy goods from you and you're not really sure of who they are, you could always ask them for a letter of credit. Obviously advance payment's the best, but if not, you can ask for a letter of credit. But it's really between yourselves really, and who holds the strongest bargaining power, I suppose, really, as to what method of payment's used.
Okay.
So it does depend on the country and the country of risk, really, I suppose.
All right, thanks.
Okay. So the next slide is what we call the documents against payment. Now, documents against payment is also known as cash against documents, or it could also be known as documents on a collection basis. Now, the main thing with documents against payment is that all of the documents go through the banking system. Now, if the goods are being shipped by sea, then it's quite a safe method for you to ship the goods abroad. If they're going by sea, the main thing to do is for you to get the full set bills of lading. If the goods are going by air, then the goods go on the aircraft and the original air consignment note goes with the goods. So let's say you're selling to somebody, say, in India, and you're sending the goods by sea. So looking at this slide, we see at the top the exporter, which is yourself, and on the right-hand side is the importer. So as I said, the main thing between yourselves is the sales contract. So once the sales contract is in place, then you can look at that sales contract and say, great, I'm going to ship my goods. So you ship your goods out to India, who's the guy in India who's importing the goods in. Step 3 is you get the full set bills of lading and all of the documents that are needed, and you send them into your bank. Your bank will then send them across to the bank in India, which is the importer's bank, and the bank in India will then speak to the importer and say, look, we have these documents here, say value £50,000, for example, saying that goods are on the way. And they ask the importer if they want the documents. The importer will then say to their bank, yes, please, I'm expecting those goods. Please debit my account and give me the documents. So the importer then authorizes payment, and the payment's then made from the presenting bank, and the proceeds are sent through to us as step 7. So step 7 has been done, and really what you're not seeing there is probably number 8, where the presenting bank gives the documents to the importer and he can go down to the docks and get the goods. And also on number 8, the payment is then made by us to yourself. So it's a secure way of obtaining payment. But the unfortunate thing is there's no guarantee of payment under it. So although we've sent the documents on to the presenting bank and therefore the importer, if the importer's changed his mind in between agreeing the commercial contract between yourselves and now decide he doesn't want the goods, he can say to the presenting bank, I don't want those goods anymore. Please send the documents back. So the presenting bank will then send the documents back to us, and we give them back on to you saying, we're very sorry, but the importer doesn't require the goods anymore. So you've still got control of the goods because you got the bills of lading, but you're going to have to either arrange for somebody else to buy the goods in India or arrange for shipment of goods back. So documents against payment, it is a fairly secure way, but really you've got to have a bit of trust in the importer, knowing that he's not going to renege on his contract with you. So that's one thing to think out on. There are methods that we can protect yourself later on, which I'll go through later on. So, say you've decided with your customer in India that you're going to do documents on a collection basis or documents against payment, but he comes back to you and says, I'd like maybe 90 days credit, please. And you think, right, what can we do there? So then looking at the next slide, we're talking about documents against acceptance. So again, there are various lines there, and it does take a bit of studying, but it's something for you to maybe study later on. But it's basically the same procedure. Sales contracts agreed between yourselves, but the big difference on this is that you're coming to the bank and saying to us, please ask the presenting bank to release documents against the importer's acceptance of the bill of exchange. Now, if you go through there and look at step 5A, the presenting bank requests the importer for acceptance of the import bill. Only upon acceptance of the draft for future payment are the documents handed over to the importer. So say the importer has accepted that bill, payable in 90 days' time, and the presenting bank gives him the documents. The importer can go down to the docks and get his goods. The presenting bank sends us the advice saying that, they're going to pay in 90 days' time. However, 90 days are up and the importer has gone bankrupt and he can't pay the bill. So the presenting bank won't pay us any money. They'll come to us and say the accepted bill is unpaid. Or if the importer gets the goods and he decides, well, there's something wrong with the goods, I don't want to pay that amount, he won't pay. So as you can see, with documents against acceptance, there is no guarantee of payment again. So documents against acceptance, you really have to have some trust in the importer. If it's going to be an ongoing relationship and you have a bit of trust there between yourselves, then this is the time really you can really look at documents against acceptance.
Martin,
so,
if I could
yes?
chip in for a moment. In the situation you just described, where something's been sent out to a country and it's going through customs clearance and the importer is waiting to get it, if there's a delay and a problem and it's not caused by the person who's buying, but let's say it's stuck in customs or someone's, the stuff has gone missing and there's a problem at that end, is all the risk on you as the exporter? Is that really what that does?
On this documents against acceptance?
So you ship your stuff out there and they go down to the port to try and collect it and they find that there's a problem. So I think a lot of people are concerned about what goes on during customs clearance or agents in ports in countries that they're not familiar with, and they trust the bank, probably trust their customer, but they're not sure about the kind of grey area in the middle where it's all to do with people in the ports that are handling their goods. Are you exposed to that if you follow these sorts of processes?
Well, with these sorts of processes, one of the main things to consider is the insurance. So you need to have insurance in place. So again, between yourselves, you'd work out who's paying the freight and who's paying the insurance. And if the importer says to you as an exporter, well, I'd like you to insure the goods, please, one of the documents you would have then is an insurance document. So that insurance document covers you against cargo insurance, and it's insurance up to the importer's warehouse. So if that's one of the documents presented under the collection, then they would have that insurance document there, and they could go to the insurance company and claim for the actual goods. And likewise, if they want to pay the insurance, then that's the risk is on them then.
And the other question that's come through from those two examples is that if you find you're in a situation where your goods need to come back because you're not getting your payment, do you have to then pay customs and duties and things like that? Do you end up with extra charges over and above shipping typically?
You do. You're in control of the goods then, so you would have to pay for all of that. So you can see documents against payment, having no guarantee of payment, can cost you a bit extra money. So it's really, you'd only use documents. Yeah, you'd only use documents against payment or acceptance really with somebody that you have a fair degree of trust out there, happy to take the goods and make the payment. Okay, so then the next slide we're going to look at is documentary credit. So under documents against acceptance and documents against payment, the main problem there is that there is no guarantee of payment. Typical costs for a collection, documents against payment or documents against acceptance, typical costs would be, just for example, say £80. But one way you can ensure and protect yourself against payment is by using a documentary credit. Now, documentary credit, just for a rough scale of charges, may be around about £250 to £300. but you have guarantee of payment. So as long as you know the charges in the first place, and I would always suggest that you go to your bank and ask your bank what would the charges be for us presenting documents under a letter of credit, and ask them how much they would charge. So documentary credit is basically a guarantee. It's a conditional guarantee which the importer's bank promises to pay you as long as documents tie up to the letter of credit. So this is really useful where it's somebody that you've never really dealt with before. So again, we use India as an example. So somebody in India wants to buy goods to the value of, say, £20,000 from yourself, and you agree between yourselves that you want a letter of credit or a documentary credit. So again, the most important thing on this, as with all transactions, is the initial commercial contract. So the initial commercial contract will state what the goods are, who's paying for the insurance, what the currency is, etc. So you agree between yourselves that you're going to use a documentary credit. So if we'll follow this process through, because it is quite complicated at first. So the importer will go to his bank and ask his bank in India to open a letter of credit in favour of yourself through your bank. So you would give your bank name to the importer. So they go on to the bank with all these instructions, and the importer's bank on step 2 would issue the DC through the what we call the negotiating or the advising bank. The advising bank will then send that letter of credit onto yourself. You receive that letter of credit, and then the most important thing is to check that letter of credit against the commercial contract. This is really important because you have to comply with all the terms of the letter of credit in order to get paid. So you check the latest shipment dates, etc. on that. If you're happy with that, then you can go ahead and make the goods. Now, a letter of credit is also useful if you're making something bespoke for that particular importer. So if you're making it for him and only for him, if you have a letter of credit, you've got this guarantee of payment. So you can make it specifically for him. So you can go ahead and manufacture the goods, and then on step 4, you'll ship the goods out to the importer. And again, they're going by sea in this particular case, and it's a full set bills of lading required. Step 5, you then get the documents ready to present under the letter of credit. Now the documents under the letter of credit have to tie up word by word and line by line. Bank staff, when they're checking these documents against a letter of credit, they don't know anything about your particular business, and they will just check the documents as they are. So if there are any spelling mistakes, then the bank will reject them as discrepancies. So you have to make sure everything ties up. So on step 5, documents are presented to the negotiating bank. The negotiating bank will check the documents against the letter of credit, and if there are any discrepancies, and bearing in mind maybe 75–80% of documents presented are discrepant, there will be discrepancy fees of around about £70. So the documents are clean. Step 6 is we send those documents on to the issuing bank. The issuing bank, again, they check the documents against the letter of credit, and if they deem them to be correct, they will then say to the importer, documents are presented, we're going to debit your account with the payment, and we're going to give you the documents. So step 7, the issuing bank has done that, and they're going to send the payment on to us. We receive the payment, and we can then pay yourself, and you receive your cash for it. And step 9 really is the documents are received. So the importer can go down to the docks and get his goods. So the main difference on this to a documents against payment is that the importer has to pay if the documents are cleaned. The issuing bank won't ask them if they can pay it, they will just debit the account and send the documents through to the importer and sending the proceeds through to us. Another good thing of a documentary credit, whereas on the previous slide we talked about documents against acceptance, on a documentary credit you can give the importer 90 days credit. That's not a problem. You can say to the importer, right, we'll send the documents on, and once you receive the documents then you have 90 days to pay us. So there is a guarantee there from the issuing bank that they will pay us in 90 days. And again, if that 90 days is too long and you need the cash up front, then if you present the documents to us and they're clean, then the negotiating bank can discount those documents and give you the cash on day 1. And we will charge the interest to either yourself or to the importer, depending on what's agreed in the first place. So it is a cheaper way of obtaining finance. you can give the importer 90 days. He's not going to pay the issue bank till 90 days down the line, and they won't pay us or the negotiating bank until 90 days time. But we've already paid you on day one and taken interest off you. So one other thing to think about with documentary credits is, although the importers open the letter of credit, we have to look at the bank and country of risk. If it's what we deem to be, or what banks deem to be, a fairly risky country, then they may charge extra for adding confirmation. Confirmation is added by the negotiating bank, and confirmation basically means that no matter what happens to the issuing bank and that country, the negotiating bank will pay you without any problems, without charging you any extra. So confirmed letters of credit will be used, for example, if you're looking at somewhere like maybe a little bit, what we'd call maybe a little bit more risky than, say, for example, India. If you're exporting the goods out to, say, maybe Indonesia, where the country isn't as advanced as India, typical charges for an Indian confirmation would maybe 0.5% per annum, whereas somewhere like Indonesia, we may charge maybe 2% per annum. So one of the things to look at is which country you're sending the goods to, and then ask your bank how much it would cost for a confirmed letter of credit, because you then have the guarantee of payment. Now, letters of credit is a very big subject, and it's something that you could maybe talk to your bank about at a separate stage, and all of the different methods of payment, etc., that can be used. But for this example, I'm trying to go through it in a basic sort of way. If we look at the, sorry, yeah? Yeah.
Just interrupt. There's quite a few questions coming up, but I think a lot of them would actually be more relevant later on once we've heard from Denise and later on from Naz. So perhaps I think we're moving on to the subject of risks, which I think you're about to speak to. If we could skip through that fairly briefly, get into the other speakers, then we'll be able to ask a few of the questions that are stacked up with your presentation. Would that be all right?
Yeah, that's fine. That's fine. So just quickly looking at the last slide is looking at the risks. So when you're looking at exporting to a particular country, you'd look at the country risk, which political, import-export regulations, transfer risk and currency controls. But again, ask your bank about that. If you go to your bank and say, look, I'm thinking of exporting to so-and-so country, what would you recommend? And they'd come back to you. You've also got commercial risks, so that would decide on whether you're using maybe a letter of credit or documents against payment. You have industry risk, which is what you're looking at in your particular industry. Currency risk, again, that's going to be discussed in great detail later on. But what I would say to you, if you're looking at dealing with a customer, say, in the Middle East, then if you're quoting to them in the Middle East, you'd maybe want to quote in US dollars, for example, because Middle East countries are generally tied, well, they are tied to the US dollar. So if you look at the contract and asking for payment in US dollars, if the company in the Middle East has got 3 or 4 quotes coming in, and 3 of the others are in US dollars and yours is in sterling, they are more likely to look at the US dollar quotes because they understand what the US dollar means to their currency. So I would always suggest you quoting to them in, say, US dollars, and then looking at some sort of hedge, which is going to be talked about later on. Then you also have performance risk and transportation risk. And that's basically the problems that you'd look at when you're looking at exporting, really.
Martin, thanks very much. That was very helpful, and I think it's given people a lot of insight into the different sorts of products. Before we get on to the next speaker and a few more questions, we've got another poll on just to get a sense of where people usually direct their export finance queries. So what you're going to see are a set of sources where we believe most people go for most of their queries on this topic. If you could keep clicking away in the audience, just to give us a sense. And we're about halfway through. Just another few seconds, if we could, for the last few people. Nearly there. And we can probably take a look at the results sometime soon. Okay, so it's basically the banks, for obvious reasons, and the free sources of information, and the people that you have to pay for, I guess, get the least number of queries. That's what that seems to be saying. Anyway, let's move on. We've got government agencies as one of the answers there. We've now got Denise Rowley from UK Export Finance. Denise has spent a lot of her time both working in the private sector, working with credit risk protection and related areas of risk, and she's going to be speaking now about how UK Export Finance can help with some of the topics that we've been talking about. Denise, if you're on the line, I'd love to hear from you now on how to get paid.
Good afternoon. I'm delighted to follow on from Martin and offer you some more thoughts on how to get paid. But first of all, I thought I'd better tell you a little bit about who we are. We're a separate government department, UK Export Finance, and we're dedicated to supporting exporters, along with our big sister government department you may be more likely to have heard of, called UK Trade and Investment. We have the same minister as UKTI, Lord Green, and Vince Cable above him. And a couple of years ago, our remit was expanded after the credit crunch in response to gaps that it was seen had emerged in the private commercial markets. And we developed some new products to support smaller companies, which I'm going to tell you a bit more about. And in order to spread the word about them, export finance advisors, 12 of us, were appointed across the UK, and I'm one of those, and they can be your local contact and your way to find out more. We work in partnership with UK Trade and Investment, and it's very important to say we're not there to compete with what your bank can offer you or the world of credit insurance can offer you. We're there to complement what they do and support what they do to fill gaps and help you overcome hurdles to exporting. Now back to our topic, how to get paid. And Martin gave us a super structured analysis of the risks that face exporters in his last slide. And I think it is worth saying that most companies will already be mitigating, they'll be dealing with some of those risks by using basic business common sense, which often really in our world is termed credit management practices, best credit management practices. And they will be to assess the risk of the country you're going to consider selling to. You can ask your bank, as Martin said, you can ask UK Trade and Investment. You'll have your own knowledge of current affairs to try and work out whether something that's going to happen in your customer's country could prevent you from receiving your payment. Assessing your customer's risk, their creditworthiness, their ability to pay you for the amount they owe you on the due date is a bit harder. But there is a world out there of credit information providers, credit reference agencies, who for a fee will provide you with a report on your customer, their financial background and their creditworthiness. The next thing you'll be doing as best practice is, of course, to, as we raised earlier really, try and negotiate the most advantageous terms of payment, advantageous to you. So you will be looking at payment in advance, if possible, followed by a hefty deposit if you can't get 100% in advance, followed by a documentary credit, also called a letter of credit, as Martin explained, confirmed by a bank in the UK if necessary. And you'll work your way through until you may have to consider terms of payment that don't give you much protection at all. You will be releasing your goods before you get paid. And in those circumstances, you may well want to consider the use of credit insurance, which is an insurance policy protecting you against the risk of non-payment for either political, economic or commercial reasons. You pay the insurance company a premium, they pay you a claim of a percentage, usually quite a high percentage of anything you haven't been paid by your customer. The last thing you'll be doing is monitoring your sales ledger. which means you'll be keeping good records, you will know when your due dates of payment are, and hopefully you'll be devoting some resource to chasing any amounts that aren't paid. And again, there is a commercial world out there of debt collection agencies who for a fee will chase your debts for you, even in quite far-flung parts of the world.
Denise, before you move on to the next slide, there's a couple of points that have come out of what you were just saying. You've talked about the need for companies to assess risk, and I think certainly for country risk and some of the bigger factors, a lot of folks know more or less how to go about doing it. There's plenty of advice, particularly for the smaller companies that are looking at places like the BRICS regions, Brazil, Russia, India, China, or looking at parts of Eastern Europe where the banking systems aren't quite as developed as they're used to with the UK and other markets. Credit reference agencies aren't necessarily that reliable. They're certainly, it's not clear how much you can rely on information you get. Do you have any thoughts, views, advice on what to do in places where you can't get customer risk assessed in the way that you would in the UK?
I think it's to look at the bank methods of payment, like documentary credits, with a confirmation from a UK bank if necessary, to really improve the risk, or to look at a credit insurance policy, because the credit insurer has a huge database of buyers, including in far-flung markets, and will assess the creditworthiness on the exporter's behalf. All these measures do carry a degree of cost, but hopefully that can be built into the sales price.
Sure. Martin, do you have a view on the same question from a bank's perspective, where you've got customers dealing with other customers and they might not have insights from usual sources? What's the bank's view on some of those things?
Yeah, if you're having trouble finding out about the sort of credit risk of that particular customer, I mean, a letter of credit is a really good way to do it. The other thing to do is to ask your bank if they can do a status inquiry on the customer. If you can find out where the bank is of that particular customer abroad, you can ask your bank to do a status inquiry on them. Now, it would mean your bank would go out to their bank, asking them a few questions, and it depends on the answer that the bank receives. They're not going to receive anything along the lines of, yeah, they're good for £200,000 or anything, but they may well come back and say, yeah, they've been a good customer of ours for so many years. I mean, that's one other way that you can do it, is to go and ask your bank to find out about that customer.
That's really helpful. Thank you for that. Denise, back to you, please.
Well, I'd better talk a little bit about what my department can do to help in these areas we're talking about. And I'd like to cover something that fits in well with what Martin was saying about letters of credit, because we have a product that helps the bank confirm letters of credit. We can also help a bit where you're able to negotiate a nice advance payment, a nice chunky deposit, but your customer wants you to put a bond up in return. And we can help a bit with export credit insurance, where the private credit insurers aren't willing to give cover. So our products, if you like, are there for when a piece of business is viable and you want to either go for a piece of business or you want to accept an order, but your bank might want a little bit of extra support that we can offer, and your credit insurance isn't able to cover the risk. The first thing I'll talk about is the letter of credit product we have. This works behind the scenes, really, where you have talked to your bank about being paid by letter of credit from probably quite a tricky part of the world. It could well be in Indonesia, or Russia, or China, somewhere in the Middle East or Africa, let's say. And your bank is willing not only to help you with getting the letter of credit set up, but also to add its confirmation, its guarantee to that letter of credit, meaning that you aren't reliant on the bank in your customer's country looking at the documents and having the wherewithal to get money out of the country and over to the UK. It possibly could be the case where your bank is happy to deal with that country, happy to deal with the bank that's going to issue the letter of credit, but doesn't quite have enough capacity, appetite, willingness to confirm the full amount of the letter of credit. Well, in those situations, it might just help if we offer to guarantee up to 90% of the value of the letter of credit to your bank. And that's what we're willing to do in many cases. Quite a number of banks have signed up to work with us on this product, including HSBC. And we have the availability, of the appetite, the willingness to look at a wide number of banks in a wide range of markets. Must be said that if a UK bank is going to add its confirmation to a letter of credit, they're the ones taking the risk that when the documents arrive in the your importer's country and with their bank, that there aren't some discrepancies and problems found there. So you have to expect your bank will want to charge for offering you their confirmation. We don't make any charge. The bank just shares a bit of their fee with us. The next product I'm going to mention should help a bit in that situation where you have been able to negotiate a nice deposit from your customer, which is of course part of your risk protection. Let's get a nice chunky deposit, can help with your working capital needs and helps minimize your risk. But in certain parts of the world, particularly the Middle East, customers can ask in return that you get your bank to put a bond up to the value of that advance payment, so that if in time it's found that you aren't able to perform the contract, you can't ship on time, let's say, something goes wrong, your customer can get their deposit back by calling the bond. The bank may well say, yes, we'll put a bond up for you, and when the deposit comes in, we'll hang on to it because that'll be our security if the bond is called at a later time. But you want that deposit because it'll help you get going with your contract fulfillment, the costs of fulfilling the contract. We'll try and help. If your own business meets our credit assessment criteria and the bank's, we will look to give the bank up to 80% as a guarantee on your behalf, so that in return, hopefully, the bank won't hang on to at least 80% of that deposit. They'll release it to you so you can get on and do the business.
Denise, are there any limits on order size, upper or lower, for that sort of product?
Not as far as we're concerned. It may well be that an exporting company's bank has certain lower limits below which they feel their own fees would sort of negate the benefit. But in principle, we should be able to look at any size from smallest to biggest.
And the other question that's come on that product, is this the sort of product that would be useful for, let's say, an IT company that works on projects where they're delivering something over 6 months or a year and they're getting staged payments? Would this be the situation where a bond might be useful?
Yes, it could be ideal for that. If the customer asks for something to be put in place, it could be called a bond, it could be called a guarantee, it could be a standby letter of credit, whatever it is that the customer requires in return for releasing payments, we can look to support the bank so they in turn can support the exporter.
Because one of the questions we had from someone in that exact situation in a country, they've come across this request for the first time in their lives, and their first question was, is it normal? They're not even sure if this is a standard thing that people ask. It sounds like what you're saying is in some parts of the world it is pretty standard to ask for this. Would that be correct?
Yes, I'd say it is. I don't know if Martin would agree. We come across bonds and guarantee requests, particularly from the Middle East, but also quite a wide range of other countries. Martin?
Yeah, it would. We get bonds, Middle East and Africa regions, really, I suppose, as much as anywhere. And they're generally the places where you get them from. And again, it's all about the commercial contract that you arrange between yourselves.
It is indeed. And the way to start this process off is usually best to talk to your bank because, as I mentioned earlier, the bank must feel the whole thing is viable in the first place and that their customers' financial position meets the bank's basic credit assessment criteria, as indeed it must meet ours. And the very best way we go about something like this is to have a three-way conversation between the exporter, their bank, and us, and we see if we can do anything to help. The last slide from me, and product I'd like to mention exists, is the export insurance policy. And this one is straightforward credit insurance, which means it's an insurance policy with a particular customer for a particular contract, and it covers the risk that the customer won't pay, or can't pay really, can't pay for some reason to do with their country's situation. The country has run out of foreign exchange, or the company itself has gone bust, or simply doesn't have cash, they've run out of cash. A premium is paid to us, and if money doesn't come in from the buyer 6 months after the due date when it should have come in, we will look to pay a claim of something like 90% of whatever hasn't been paid, or the costs that were incurred in trying to fulfill that contract, which hasn't been able to complete because of, let's say, a political event in the country. We're very happy, as we are with all our products, to look at consumer goods, manufactured goods, the provision of services, whole range of sectors, credit terms, a period of risk up to 2 years. The thing we can't look at, though, for credit insurance is helping exporters dealing in Europe or what we call wealthy OECD markets, meaning Australia, USA, Canada, those kind of territories. That's because the private credit insurance market, companies like Atradius, Cofas, Euler Hermes, and several others, should all be able happily to cover those risks. We aren't there to cover bad credit risks in Europe, although, my goodness, that certainly does pose a risk too. We're there more for the difficult territories. We're busy looking at credit insurance protection for exporters in countries like Russia, Libya, and, as a little exception to the No Europe rule, Greece. This is a conditional insurance policy, as indeed all insurance is, meaning the exporting company must have complied with the terms of its own contract, and that takes me back to another of Martin's boxes. There always is a risk for the exporter in that they need to be able to perform under their part of the contract. We can work with banks by making claims payable to their bank as a loss payee, if that will give the bank some comfort. And we're very happy to talk to exporters directly about this policy, or they're welcome to consult with a credit insurance broker. There are lots of specialist brokers who operate in this area and know what we can do to supplement what the private credit insurers are currently doing. And really that's all from me, and unless there are any questions.
Denise, that's been very useful. There's one piece of information that seems to have really taken people by surprise. A couple of people have asked me to just dig a bit deeper. Where you said there's no upper limit in principle, just as an example, if someone typically has letters of credit of 100,000 and they found a deal for £1 million, are you saying that as long as it sort of meets the various risk criteria, you'd be comfortable looking at something like that?
In principle, UK Export Finance has really huge appetite and capacity, but of course, as you rightly say, it's all to do with the credit assessment on either a company, if we're doing a credit insurance policy, the overseas company in its country. If we're looking at one of those letters of credit support products, we'd be looking at what capacity we've got in that country and on the issuing bank, the importer's own bank, and there can be constraints on that, of course. I have to say it's case by case, but in principle large figures don't frighten us.
Okay, that's excellent. We're going to move on to NAS and move on. Before we do that, the final poll is on some information on how people protect against currency exposure, because that's really the topic we're about to cover. So the poll has a couple of questions on it. Do you protect do you usually know what rate of exchange to expect, or you don't really understand quite what's going on in this? Because that'll give Naz a little bit of context for the points he's about to make. And we're working our way through. While we're waiting for that, Naz, we're coming up to about 1/4 past. I think we've got a few questions left. I'm sure there'll be a couple more coming through while you're talking, but if we could leave 2 or 3 minutes at the end to wrap up, that'd be helpful. Okay, so let's have a look at what the answers are at the moment. And what we're finding is that most people seem to not quite understand what this is, so perhaps that's a very good segue for Naz to explain. Naz is an expert in the currency markets, the fundamentals, the technical analysis, and really the insight into foreign exchange outlooks, because that's really the area we haven't covered. We've talked more about country and company risk. But Naz, if we could welcome you to talk to us a little bit about currency aspects, please.
Good afternoon, everyone. Thanks, Waz, for the introduction. Quite an interesting result to the poll. I think that speaks quite well to what I want to cover with everybody today. In the interest of time, I'll move very quickly through the first couple of slides. In terms of what I would like to cover with everybody today, 3 main areas, and that is, Martin kindly looked at some of the risks for businesses trading internationally, and what I want to do in this part of the presentation is really focus on the risks. And the 3 main areas that I want to focus on: number 1, highlight the currency risk that exporters can face; number 2, demonstrate that risk and underline the importance of protecting your business; and number 3, just move forward to look at some of the solutions and tips for success. Just wait for the slides to catch us up. Okay, in terms of an introduction then, what I would like to do really is to put the foreign exchange market into better context for businesses already trading or thinking about trading or exporting. And I think there's 2 key things to bear in mind. Number 1, about 90% of transactions or trades have nothing to do with international payments, but are actually executed for speculative or investment reasons. And also, foreign exchange is the world's largest financial market. Trillions of dollars exchange hands every single day, 24 hours a day. So I think it's important for an exporter to understand and fully appreciate the environment that they're going to be working in. And where does Western Union Business Solutions fit into this global market? Well, like many others in the market, we help businesses spend less time weighing international payments and currency risks and spending more time taking advantage of opportunities and growing their core business. So moving forward into risks associated with international trade, and as I said, I would like to focus on one in particular, and that is currency risk, also known as transaction exposure. Transaction exposure is probably the simplest and most transparent risk. By definition, it's the loss when the exchange rate applied to, let's say, invoices or contracts changes. So any unanticipated changes in exchange rates can have a damaging effect on a business. So every company, whether it's an importer or an exporter, is exposed to currency risk, and vulnerability to swings in exchange rates can compromise profits and undermine a company's success when working overseas. And I would like to support this example about currency risk or challenges facing exporters with some of Western Union's own research. Every quarter, the Business Solutions team surveys its customers to understand what are the key challenges when trading internationally. And the International Trade Monitor covers almost 700 different types of UK SMEs, and it tracks the confidence and sentiment of importers and exporters. And what we found from the latest data covering the first quarter of this year showed that currency volatility or swings in exchange rates was the #1 concern. to touch quickly on cash flow and how currency risk or currency exchange fits in with cash flow management, I think it goes without saying that forecasting and managing cash flow can be a bit of a headache. And the only point I really want to make here is that it becomes especially harder for companies who deal with foreign currency invoices but do not have an organized way of tracking or visualizing them in terms of their currency risk. But saying that, there are online tools from currency providers that offer business a range of cash management solutions. I want to talk a little bit about protecting your business from currency risk, and probably the key area of this final part of the presentation. And I want to start by just quickly defining the graph that you can see in front of you on the slide. What you can see is the value of the pound against the US dollar. It's the exchange rate from the early parts of this year. And what I want to do is use this graph to really highlight currency market volatility. So by looking at the chart, you will notice that at the beginning of the year, January 2013, the value of the pound, or £1 was worth around 1.64 US dollars. Come February, March time, within less than 3 months, the value of the pound fell to 1.49 US dollars. If we think of a transaction, let's pick £20,000, a £20,000 contract or an invoice, that movement could mean the difference of about 3,000 US dollars, or a huge 10%. Now that 10% movement underlines the need to protect your business against currency volatility. And that 10% movement also underlines the need to create a risk management strategy that's suited to your business. There's no one-size-fits-all when it comes to this. Every company will have a different type of currency profile, but the benefits of having a strategy in place are pretty clear. Above all, a strategy will help a business trading internationally, an exporter, to manage and protect its money in volatile markets. And by that, I mean benefit from a favorable currency movement as well as reducing exposure to adverse currency fluctuations. Ultimately, and I want to stress the concept of strategy, a strategy will help a company protect its bottom line and maximize its profits.
Naz, could you give us an example of what a strategy might consist of? Maybe your case study will help with that. But I think a lot of people understand the concept, but they're not quite sure in practice what they do, particularly the smaller companies, to have a strategic view on, or have a strategy that will practically help. I
guess that's the job of a payments expert, to kind of extract that information from a customer and to try and build what I mentioned earlier, a currency profile. Every business will have a different currency profile, cash management needs, level of risk, different types of currencies they're working with, and based on that, you may have one very simple tool as a strategy, or you may have a combination of tools and solutions to help you manage that risk. And it really depends on the exporter or the individual business's payments profile.
I think your next slide is up, Naz.
Oh, hello, sorry. I'm back, okay. Okay, so just to quickly, before we look at the final slide, pitfalls and tips for success, in terms of the solutions that we've just kind of touched on, an international payments provider, be it a bank or non-bank, typically offers a variety of products and services. And these can range from very simple tools to highly advanced services. And I guess the two that exporters typically use to manage their currency exposure will be spot payments and forward contracts. Now, I can go into the definitions and the technicalities of these products, but what I would like to do is fast forward into a case study, an example of how one exporter managed their currency exposure. And I'm talking about a UK-based manufacturer based in Northampton in the Midlands, a manufacturer of high-speed precision cutting tools supplying to companies in Europe. And this company in particular was exposed to risk by only engaging in spot deals, so making on-the-spot currency conversions whenever payments came in. And what they did by working with a payments provider was strategically use forward contracts to hedge their currency exposure and minimize their risk against currency volatility. And the execution of the forward contract was actually done using a 24-hour market orders product, achieving a rate that actually turned out to be better than what they budgeted for. The customer covered their currency exposure until mid-2014, so covering their currency needs for a period of well over a year. And by analyzing the foreign exchange markets before the transaction and the subsequent volatility, the customer worked out that they actually saved about £30,000 on exposure of around £2 million worth of euros. To go alongside the savings, they also now have far greater transparency in their cash flow process.
Naz, we'll need a couple of minutes for questions at the end, but there's one question that's come out on what you've said so far. People have asked if a useful tool to mitigate this kind of risk would be to run a dollar account instead of a sterling account to help with this kind of exposure. Do you have a comment on that?
Yeah, I guess it depends on whether there will be a need for outgoing US dollars. So if you're getting dollars in and you have a need to then use those dollars to make outgoing payments, then yes, one option would be to run a US dollar account, obviously taking into consideration fees and kind of the setup process. Or you could also have some currency providers will offer exporters or importers holding accounts. So giving you a period of, let's say, 60 to 100 days, for example, to bring your dollars in from a transaction, hold on to those dollars until you need to make an outgoing payment.
Thanks. We're almost out of time. Would I be able to move on to questions? Are you nearly at a point where we could do that?
Sure. So I guess I'd like to finish off with my tips. And my tip is very simple, is to speak to an expert. You really need to understand the market that you're now operating in. And as I mentioned at the very beginning, making international payments means that you're now exposed to the world's biggest financial market, and you really do need to appreciate that. And as I demonstrated with the graph earlier, you will have to manage currency volatility to protect your business, of course. And furthermore, by understanding the market and these risks, you can then recognize where your business and currency needs fit within this new environment. And then on the back of that, you can create a suitable framework of one or more products or services, a strategy, which I talked about, that will help you manage and stay on top of this challenge. And what's key is that this approach can help you protect your bottom line and maximize your profits. Thank you.
No, thank you very much. That's been very helpful. We've only got a minute or two left, and so I want to cut straight into a summary of 3 or 4 questions that have come through. And this is really 30 seconds each from Martin and Denise. I think what seems to be coming out from the questions is that a lot of this area is about managing risk using products, but ultimately it's down to your commercial negotiation. And the 2 questions I'd like you to comment on is, one, if you're a small business and things get into trouble, if you can't afford to litigate in these countries, then are you really any better off? Do you have any advice on companies that will struggle to enforce using the legal frameworks around their commercial contracts? And secondly, where can you get the kind of day-to-day advice on things like getting your LOC drafted properly so you don't have these issues, or detailed advice on the commercial negotiation? Because that's where I think most people are feeling uncomfortable with some of these issues. Denise, do you want to give a couple of comments for a few seconds, please? Denise, are you on the line? In that case, perhaps
Hello.
Martin, if...
Hello.
Oh, sorry, no, Denise is
No,
there. Denise, you get the question?
I'm so sorry. I think it would be very easy to say, don't get into that kind of situation in the first place where you've got to litigate. Try and get better terms of payment, like a letter of credit. If you are in that situation, I think a good place to go is a debt collection agency. Lawyers are terribly expensive. With regard to help getting a letter of credit set up the right way, very good point. Go to your bank first, but there are companies out there who offer hand-holding advice.
Great. Martin, any closing comments on those 2 points, please?
Yeah, I'd say use the experts around you. I would say use your banks, use UKTI, use the Chambers of Commerce. The Chambers of Commerce will often have a department that will do letters of credit and do the documentation for you. Obviously it's for a price, but they're also there with expert advice as well. The local Chambers of Commerce, I mean, sometimes they even have bank staff there working for them, so they'll be used to using letters of credit. But before you set your letter of credit up, I would speak to your bank and see what are the risks involved, what can you do to protect yourself, and that's the main thing. And then the banks generally work in conjunction with UKTI and the Chambers of Commerce, and it's using your network. And the bank will also suggest to you to use your lawyers if you have a lawyer. I mean, you can get some free advice from some of them. It's just really you need to get the commercial contract right in the first place.
Martin, can I offer one suggestion, see if you agree?
Yeah.
I think companies are well advised to talk to their normal bank contact, but especially ask if they could be put in touch with an international manager or a trade manager, someone with expertise in international trade.
Yep,
that's Martin, right. Thank you very much.
Should always
time on.
do that.
I'm going to have to cut across because we're out of time, and I'd like to avoid us running over just in case the webinar shuts down while people are still on. There are a whole load of questions that people have still yet to ask. If you do register on Open to Export, you'll be able to ask those questions, and the people that have been speaking, plus several others, will be available to answer the questions. The other thing is that we've got another couple of webinars coming up, and one in particular, the one later on this week on how to finance your invoice, picks up on one of the questions someone asked about invoice factoring and related subjects. But with that, thank you very much, everyone, for both taking the time to listen and ask questions, and, of course, to our speakers. Thank you, everyone, and look forward to seeing you on the next one. Bye for now.